afternoon, everyone. A warm welcome to IRX Residency and Citizenship Conclave Virtual Edition. It's great to have you all joining us from different countries, along with our esteemed speaker together on this platform. Looking at these challenging times, we at GMN Media have put together this platform as an opportunity to educate all our esteemed investors, investment bankers, lawyers, immigration and real estate consultants about the attractive international investments along with various citizenship and residency programs on offer. This presentation will be for 15 minutes followed by 10 minutes of Q&A. I would request all our attendees to be on active speaker mode. During the time of Q&As, all attendees are requested to click on raise your hand button on your screen and you will be allowed to ask your question. We will unmute you so that you can ask your question. Since we only have 10 minutes, in case you didn't get your chance to ask your question or your query remains unanswered, the presenter will be available to speak to you in their virtual booth at the IRX Residency and Citizenship virtual exhibition. We will post the link on the chat for your reference. Without further delay, I would like to introduce our presenter, Mr. Art Scutaro, Vice President and Independent Project Manager for NRIA Investments, USA. He is going to present on real estate investing done right. Over to you, Art.
Thank you. Thank you for that introduction. Good morning, good afternoon, good evening to everybody, wherever you are today. It's our pleasure and honor to be a part of this. We just to enjoy the opportunity to offer, our investments, and we welcome the opportunity to share this information with you. National Realty now has been in business. This is our 15th year of successful business. We occupy two spaces, the real estate space and the investment space. Thank God we've made it through three U.S. stock market failures and, of course, the financial crisis and real estate implosion of 2008 to 2010 without any blemishes. We have zero project failures, foreclosures, and lawsuits. We've lost a little forecasted profit during those times, but we've never lost any principal for ourselves, for our investors, more importantly, and our investors have repeatedly been able to hit their targeted returns through our investment opportunity. One of the, I think, features that makes our investment opportunity unique is the way we approach our marketplace. We're completely vertically integrated. One of the strengths in our offering is that we create an equity margin before any principal investment money is put in. That's our money or our investors. The way we do that is we create relationship with local government or municipality. And then within those markets, we're in 4 major markets, and then we're in sub-markets within those markets. For those of you that know that know or are familiar with territories or areas in the United States, they are Florida, Delray Beach, Boynton Beach, Gulfstream, Florida, Center City, Philadelphia, then Brooklyn, New York, and then outside of New York City, we're located in 4 areas of Jersey: Hoboken, West New York, Union City in New Jersey, and Guttenberg, New Jersey. These areas of New Jersey are ranked 1 through 4 most densely populated municipalities in the entire United States, where statistically 80% of the residents are renters. Having said that, we're also outside of the major city, New York City and Jersey City, by about 10 to 15 minutes by boat, train, or bus, giving us an advantage close to the city but not in it, especially now with social unrest that we find in some of the major cities like New York. They're migrating to the areas that we're building in. So you have residents migrating, looking for direct ownership, also looking to rent, but wanting to be out of the major city areas. And because of that, unfortunate situation, we're benefiting. But our model is split between residential rental and residential ownership. We stay away from commercial. which right now, commercial real estate isn't doing as well here in the States because of the current pandemic crisis, but residential is booming. Our interest rates are the lowest they've been in 30 years. And thank God that is the real estate that's actually coming to market. We offer opportunity through what's known as a private placement. In a private placement, the SEC allows us to set up an LLC or company, and then our assets go in the LLC and we offer shares. The correct term is called a financial unit. A financial unit has $1 million, has a value of $1 million, but we fraction it to accommodate the investor in $50,000 increments. So as an example, for a $50,000 investment, the investors can receive a 16% annualized targeted return. On a $100,000 investment, the investor receives an 18% annualized targeted return. On a $150,000, the investor receives a 20% annualized targeted return. In our model, it's a 5-year term that the investor is in to hit those targets. We pay out 10% of their return on an annualized monthly basis, and then the balance is trued up. So as an example, if an investor put $150,000 into the fund, they would receive 10% of their annualized return immediately. Well, 10% on 150,000 is 15,000 US dollars per year, paid monthly directly or electronically to their bank account. That's $1,250 US per month. Over the 5-year period, that is 15,000 a year times 5 years. That's $75,000 that they would receive in real-time payment. At the end of the 5-year term, at their maturity date, they would also receive an additional 10% that was accruing, not compounding. That's another $75,000, thus giving an investor who invests $150,000 in our investment opportunity a 20% annualized targeted return, or $150,000 total return and the return of their principal. In this model, there is also early redemption. The investor can get out of the fund early in 2.5 years. If they choose early redemption, they are choosing a lower return of 12%. So in the model, the investor has the option to leave within 30 months at 12% and the return of their principal, or stay in the fund and hit their targeted return. Having said that, as I started, one of the benefits that we have in the fund that really secures the investor is that we create this equity margin. In our approach, we create relationship with the municipalities that we're building in, and then we hunt for specific property in that municipality. We're looking for property that we can build more on than the current seller realizes. Our model is buy any property that we choose that will have the ability to do that for us, knock down whatever's on that property, and then build from ground zero up a brand new condo or townhome complex or an apartment complex. The majority of our real estate is always in the rental sector. That's our first layer of protection. You know, regardless of the situation, you know, you've heard these terms, a buyer's market, a seller's market. It's always a landlord's market where we build. As I stated, 80% of the renters, or I should say the residents where we're building are renters. We're right outside the major cities with no more than a 15-minute computation to their job or to entertainment. And in this opportunity, we're creating this starting equity by having or obtaining property where the seller doesn't realize it, but we can build more on it. Secondly, when we find that property, we approach the seller as a cash buyer. So we're commanding a price under market value. In our purchase transaction, we're creating anywhere from 1 to 3 million of starting equity. The next step to creating this equity before capital is put in is that we're building at wholesale. The three largest developers that are publicly held companies here in the United States are Hovnanian, Toll Brothers, D.R. Horton. We have the same discounted pricing on all of our products and materials and services. We manage 1.75 billion as a company. Because of that, we're building at wholesale, but without nearly their overhead expense. And then thirdly, tax abatements. We're getting a 5-year tax abatement for condos and townhomes. That's transferred immediately to the owner upon sale. We're looking at about a 2-year build period for that. And then the owner gets this opportunity with a 5-year tax abatement. If it's a apartment building, the apartment buildings are built within the same timeline, 2 years. And then we rent them for 3 years to create a cash flow. And then those buildings are sold as cash flowing opportunities, and they're most valuable at that point. They will have 30-year tax abatements on them. The tax abatements for the apartment buildings actually bring in a revenue equal to about $400,000 a year due to that abatement. The target for the condos and townhomes are to residents who want to live in them. And then, of course, the outsale target for the apartment buildings are to institutional buyers. Institutional entities, typically like insurance companies, teachers unions, credit unions here in the United States, typically have to, put aside about 35, maybe even as high as 40% of their revenues to buy cash flowing properties to pay dividends to their own clients. So this becomes a great opportunity for us and them. Having said that, buying under market value, building more on the property, building at wholesale, and then having a tax abatement to transfer to the new owner, that creates a 30% equity margin. Today in the fund, these 18 properties that are a part of the portfolio, they make up 11 apartment buildings with 1,761 units, 70,000 square feet of retail space, and then another 7 properties with 221 condos. We started this fund in April of 2018, about 28 months ago. Currently, 60 of those condos are sold, and that cash flow is coming back to the fund to pay investors, approximately about 55 million. In addition to that, the apartment buildings are in construction. Most of the properties are all in a construction flux. Since we started the projects, just like I said, 28 months ago, one of them is complete and out of the fund. That was a condo complex. The next properties coming to market are 3 more condo complexes. There's 2 in Florida and then 1 in Philadelphia here in, again, the United States. All of our properties are located in the United States along the East Coast. One of the benefits that we also offer to our investors is we give them an Assurity. In the fund, the value in the fund today is 1.3 billion of value. Our cost is about 956 million. That difference of about 340 million or so is our net equity. That net equity is again created by the way we approach our market, not by down payment money or investor money. On top of that 350 million of equity, National Realty has about 52 million of its own skin in the game, down payment money or principal, and then the same for the fund. The point that I'm sharing with you is that this equity of 340 million or so and our 52 million make up approximately $390 million of equity sitting in front of the investor pool after everyone's paid back. The strength to that is if there is a market correction, that money sits there to be absorbed by the investors first. The other strength to our investment is that the investor pool's only representing about 5 to 7% of our capital stack. Our cost today, this $960 million, that includes paying back the banks and, of course, the investor pool. In our model, we diversify the way we raise capital. We start by going to the institutional lenders first for about 75 to 80% of our funding. That funding comes to us at a typical construction rate here in the US of about 7 to 8%. However, it also includes the interest reserve because of our creditworthiness. Like I said, National Realty is managing about $1.75 billion. The fund is worth $1.3 billion. But because of our creditworthiness and, of course, our equity in these properties, the institutional lenders are willing to give us not only the 75 to 80% of the funding needed, but also included is the interest reserve. So that means we have zero expenses for that money or carrying charges. It's covering our interest, our taxes, and our insurance on each property. On each property, there's only one lender. And again, they're covering 75 to 80% of the capital raise at a 7 to 8% rate. About 10 to 15% of our funding comes from EB5. EB5 will be covered by one of my co-VPs in the next session. But here in the States, the minimum investment for an EB5 is $900,000. The investor is making about a 6% annualized targeted return on that. And then, of course, they're getting paid when they get their visa, depending on that country. It could be anywhere from 2 years to 5 years, depending on the country. Having said that, that's 90% of our funding where we have zero carrying charges on. Typically, until the properties are built and sold, or built if it's an apartment building, refinanced, and then rented out. The strength there is that, again, in a fund like this, cash flow can cause a problem if you don't have enough to cover your expenses. In our model, 90% of our $960 million or so is completely zero monthly payments. The other 10%, that's where investors participate with us. The banks today want skin in the game. You can't borrow all the money from institutional lenders today. So in this model, National Realty puts its capital in first. We're leaving in anywhere from 1 to 5 million. It's a representation of about 5 to 7% of our capital stack. And then the balance of that money needed is coming from the investor pool. To date, we've raised here nationally and internationally about 210 million in total. And that's in the last, say, 28 months. So we pulled down from that investor pool the $1 to $5 million balance needed to qualify for these cheaper loans, 75 to 80% coming to us with an interest reserve, no payments. So the first strategic way that we're utilizing the investor pool, you're helping us qualify for the cheaper money that includes the interest reserve. And that's great, but that's not the most important role you play. As an investor, we can do that on our own. The real role that the investor plays strategically for us and why we're willing to pay a premium of 16, 18, 20% annualized targeted returns is because you're giving us the opportunity to increase our purchasing power. Now, please try to follow me here. I don't want to confuse anybody, but in this opportunity, that $210 million, we're paying out percentages to various investors in that model of 16, 18, and 20%. That's a blended average of about 18%. So on that 210 million, we're paying a blended average of 18% today. If you compare the 90% of the funding raised on EB5 and to institutional lenders, that money's costing us about 7 to 8%. Well, 8% versus 18, that's a 10% premium that we're paying to use investor money. On 210 million of a capital raise from the investor group, that's 21 million as a premium. Well, why don't we go to the institutions and borrow money? Well, we have, and they require this skin in the game, 10%. So you're putting in 5 as a group, we're putting in 5. This 10% premium, or 21 million, what does National Realty get for that? Well, the first thing is that you're allowing us to reserve our own capital, 210 million. National Realty nets an average per project of $15 million per property. Having said that, if I compare the cost for money to the EB5 and the institutional lender, as we've shared, the cheaper money gives us the opportunity now. We've preserved our own capital. If we go out and we buy 10 properties for the money we've preserved, this 210 million of our own capital, at $15 million each, that's $150 million of profit. If I compare that to the cost or the premium we're paying to use investor funds, 10% or 21 million, I think you can see $21 million of a premium making us $150 million net profit. We're making a heck of a lot more profit than we're paying out in returns. Think of the investor pool. It's 5 to 7% of the total capital raise. It's like an expensive credit line for us to produce more income. And in this model, you're assisting us to, again, preserve our own capital. The math works greatly in our favor because only 5 to 7% of the total capital raise is receiving these higher returns, and we're paying out only a portion of that return on a monthly basis, 10%. The last point I'll leave with you is that in this investment opportunity, investors are locked in for these 30 months minimum to hit a 12% return. That's early redemption. If they stay in for the full 5 years, which is the term to hit their targeted returns, they're hitting anywhere from 16 to 18 to 20%. If they stay in for the 5 years, of course, they benefit, we benefit. We're getting the opportunity to recycle their capital while they're enjoying a 10% return. So we're only paying a portion of that money to them on a monthly basis. So in conclusion, by coming into these properties, buying them under market value, building more on them, building them at wholesale, and then, of course, having a tax abatement to transfer to the new owner, we're creating this 30% equity margin sitting in front of the investor pool as security. We're building in 4 major markets, then within sub-markets of those markets. So we're diversified in the areas we're building. We're also diversified in the timing to these properties coming to the market. Of course, we're diversified in the use of those properties, the majority of it being in the rental sector, which is the cheapest source of shelter. So if there is a down market, we can just turn all of the real estate into rental property, let it rent, and then when the market rebounds, if it does suffer a correction, we can put that property back up for sale. And then, of course, the capital stack being diversified in that we're raising capital, 75 to 80% coming from institutional lenders, 10 to 15% coming from EB5, and then, of course, our own participation of principal money or down payment, 5 to 7%. That's a total of 95% of our funding, where we have 0 monthly carrying charges or expenses until the properties are built and sold, or built, refinanced, and rented for a short period of time. Our model is a buy, build, sell, and it's an evergreen fund where we're continually putting properties in and then, of course, selling them as we go. All of the funds coming back to this investment pool, and investors are paid first. We're in our last position. So you have the banks in the first position, the investor pool, and then National Realty. Having said that, you're also, like I said, diversified in the exit. We're preventing any kind of crash like we see in our stock market here in the United States. 4 months ago, before the pandemic hit, our economy was booming. The stock market had a bull run, and then there was a panic with this pandemic, and investors pulled their money out of the stock market all at one time. Lo and behold, we had a crash. Well, we prevent that here in this investment opportunity because investors have a minimum stay of 2.5 years. If they leave early, of course, they're only getting 12%, so they're leaving the other 4 or 6% behind for us as a company. And if they stay for the full term, it's 5 years. So we're preventing investors from leaving abruptly or a mass exit, creating the collapse of the fund. But that's a lot of information. I'd be welcome to take any questions now, or we can certainly deal with any information if you'd like to email. My email is ascutaro@nria.net, or our phone number here in the States, 201-210-2727. We also have our website, NRIA.net. So we welcome the opportunity to talk to you directly, or if we have some time, we can take some of those questions now if you'd like.
Sure. Thank you. Thank you, Art, for your presentation. For those who have asked about Art's presentation or any details, you can reach out to Art and the NRIA team at their virtual booth, and all the information will be emailed to you. Very quickly, Art, we have a couple of questions that came in.
Sure.
If you don't mind, we'll just quickly run by them. This is from Nigeria. We had Mr. Adekalu from Nigeria, who's written, what is the minimum investment for an investor to participate in the real estate fund from
Sure.
from the African market? Does it is there a difference in the minimum investment in India, in the African market and the US market? Because I believe in the US market, the minimum start is about $50,000, if I'm not wrong, right?
That's correct. $50 US, correct. 50,000, yes.
And what about the Nigeria and what about the African market and the Indian market? What is the minimum investment that needs to be made?
We've kept it in the Indian market. We were starting at 15,000 earlier in the last year. But I think we can still do that as an introductory investment for these smaller investors that want to try to get an opportunity to kind of get their feet wet. Here in the US, it is 50,000 minimum.
Okay, understood. Then Mr. Sinha was asked, what is the average return expected year on year on the real estate fund? How has the current COVID-19 situation affected the fund?
Sure. Very good questions. Thank God for us, the real estate coming to the market is direct ownership right now. I think there are problems mainly here in the United States with commercial real estate, as in our country and other countries, with the virus shutting down the commercial market, there has been a problem with commercial real estate. Also in the cities, the major cities, there's some social unrest due to the political climate here in the US. However, on the residential side, we see a booming real estate market because rates here, interest rates, are the lowest they've been in 30 years. And here in the United States, it's very common for the majority of the funds needed to make a purchase come through a loan from an institutional lender. And like I said, they're the lowest they've been in 30 years. You're looking at like 3%, 3.25% rates here in the US. So we haven't seen any problems thus far. We're selling off new property in major locations where we're right outside of the city, where we have migration coming to us. So we have no problems with selling these properties. And then, of course, our rental properties aren't hitting the market for about another 2 years. Remember, in our model, all the construction, all of the properties are being built brand new from the ground up. And we are right in the middle of being able to launch within the next year 3 more residential condo complexes. So we haven't seen any negative results, thank God, personally as a company. And our real estate, like I said, right now is in a investment opportunity for outside of the fund for resale, so not rental. So rental markets right now, again, if you're in the major cities, because of the social unrest, there may be some issues, but not where we're building, thank God.
Okay, great. Thank you. Thank you, Art. We've got one more question that we would like to address, which is, can you help us in case of people investing in NRIA, the real estate property, can you help us find tenants to lease out properties purchased from you? Do you manage the property and help in reselling that as well? Can you answer that, Art?
Sure.
Yeah?
Yes. Yeah. That was our previous model. In this model, investors are coming into a pool of properties, not just one. So you're not beholden to the success of any one property. You're coming through the private placement. In the private placement, you have no liability, insurance liability, financial liability, or tax liability. You're coming into the fund and you own a piece of all the properties. But if an investor wanted to purchase one of the properties when it matured and came to market, they can certainly do that at a slight discount. But the real strength in our investment is coming into our investment pool and reaping a return of 16, 18 to 20% annualized, depending on their investment level. So we don't hunt down property or find property for a specific investor to invest in. You're coming into the pool of properties that we have and own.
Okay. All right. All right. Thank you, Art, for your presentation.
Thank you, sir.
In case you have any queries which are not answered, the NRIA team will be available to speak to you in their virtual booth at the IRX Residency and Citizenship virtual exhibition. We will post the link on the chat for your reference. Please join the virtual expo via the link mentioned in the chat. Thank you so much, Art. Thank you all the attendees.